So this is our 10th annual construction update, and it's really amazing that every day this week I was watching the news wire, and there's a change in the 2 tax bills that are going through that we'll talk about later. So keeping up with all those changes has really been challenging. We're going to give you the best and most current information that we have, but I want to preface it with it's literally changing on a daily basis. So we'll get into that in a little bit. One of the things I wanted to point out on the screen was, and I'm pretty proud of, the top 50 construction accountants. So Construction Executive, I don't know if anybody gets that magazine. So it's kind of a higher level for construction executives and CEOs and CFOs type of magazine. It's a great magazine, and I'm not just saying that because they gave us an award. I'm saying that because I really value that magazine, and I get it myself, keep up on things. So we had to submit a lot of information, the type of construction clients we have, the industries we work in, how many construction accountants we have, a ton of data. And this is nationwide, so we got submitted, and we were picked, and we're number 22 out of 50 in the country. So I thought that was a big deal, and I'm pretty proud of that. So. This green button, got it. Okay, so a little bit of housekeeping. If you need CPE, you need to sign in at the desk and let them know that you need CPE to get a certificate for that. Questions, Jessica will be going around the room. If you have specific questions, we're going to try to take some questions at the end of everybody's presentation. But at the end, you can go back because we got to move along to make sure that all the speakers have their time allotment. So we're gonna clip through this pretty quick, but there will be time at the end. If you don't have time, you can always email me, and we will get every person's question answered. So here's the agenda for the day. We're already kind of behind schedule because we were waiting for the people coming in from 75, but 7:30, that's me. 7:45, Gary is going to speak. He's from Aclaimant, and he's going to talk about operating in this new COVID environment. And then John Moore is an economist and a professor at Walsh College, and he's going to talk about the economy, and he's going to have some really good information and tell us how this is all going to correct, and we're all going to make a ton of money, and life's going to be good. Right, John? Is that what you told me? Yeah. So, and then I'm going to come out after that, and I'm going to talk about, like I said, the ever-changing tax law and I call it as the world turns in Washington. So, but we'll get to that. So, one of the things that I wanted to bring up was, I'm sure if I went around the room, every single person here probably knows somebody that has passed away from COVID, or know somebody that has somebody that passed away from COVID, right? Like a second layer of somebody that passed away, right? COVID's been tragic, not only locally, not only our families, but the whole country and really the whole world. So what I wanted to do was just take a moment just to think about those people and have a moment of silence for them, because it has been tragic for the whole world. Thank you. So, however, I do want to say, for everybody in this room, I give you kudos because maybe you had COVID and you survived and you muscled through it, or you were diligent and you washed your hands 20 times a day and you wore your mask and you social distanced when maybe you didn't want to. Whatever you did, and you're here today. And for that, I say we all give ourselves a round of applause, right? So let's keep that up, and let's crush this COVID and get on to our normal lives. So with that, first up is Gary, and he's going to talk about living in this post-COVID world.
Good morning, ladies and gentlemen. Great to see you this morning. John and Jessica, thank you again so much for having me today. I really appreciate this. And thanks to everyone at UHY for putting on this first class event. Make sure I get these clickers down correct here. So I'm going to talk about some legal stuff here along the way. Just wanted to make sure you understand I'm not a lawyer, so if there's something that really catches your fancy here, you might want to go get some subsequent legal advice in this regard. I don't know how much you know about me, but I've been in the risk management business for 40 years. And I have been both an insurance broker and a practicing risk manager and a risk management consultant. Dealt in risk financing and all sorts of other areas. Between my various lives in risk management, I've interacted with probably 1,000 different organizations at least, and have seen risk circumstances in all industries. In the course of today's presentation, we're going to cover 3 key things. What I think you need to know most about the world of risk these days, what to do about it, and how to go about doing something about it. So I'll leave room for a little question time at the end as well. Quite a few years ago, when enterprise risk management started becoming a thing, I started an enterprise risk management program from scratch for a Fortune 500 company. And one of the first things you do when you start an enterprise risk management program is start making a so-called risk register, everything that can go wrong. And so I put together a team and we started assembling a risk register. And we accumulated a list of about 650 different things that we thought could go wrong. Not limited to traditional insurance type perils, but you name it, it should be on the list. If you Google the phrase construction risk management, you will get an exhibit something like what you see on the screen right now. These are specific project risks only. It's a pretty good list. There's some stuff I would add to it. But I think you're sitting there saying, well, look, whether it's 107 or 650, I don't have time for all this stuff. Nobody does. So please boil this down to what I most need to know. And that's what I'm going to try to do in the course of this discussion. So I would like to talk to you today about 7 key post-COVID risk trends that I think affect your business, and then try to give you some guidance about what to do about it, because it's a different world, and I believe it needs to be managed differently than it had been in the past. Okay? So the first trend I'd like to talk about today, and we'll talk about each of the 7, is social attitudes. And I don't think this one comes as any great surprise to anybody here, that people are a little upset these days. Just this week, I did a little research, and Gallo does a survey of public opinion every now and then. And about a month ago, they determined that about 55% of the populace thinks that government regulation of business and industry either has about the right amount or too little. In other words, those who think that business is overregulated are very much in the minority these days. Not coincidentally, 82% of those surveyed felt that they had no confidence or some confidence only in big business. Small business got somewhat better scores. 73% in that survey felt that the size and influence of major corporations left them either somewhat dissatisfied or very dissatisfied. I work for a small technology company based out of Chicago, and we can tell you that we have kind of a 30-ish techie-oriented work staff. They want us to be involved in social causes. We hear it all the time. That's the way it is these days, and I think that the things you see on this slide probably are not any great surprise to you, but they have a lot of consequences, and we'll show you some of those specific consequences here. And I'm going to spend a fair amount of time talking about the fact that social attitudes lead to a climate of regulation and compliance. As you see in the slide, regulation is a highly imperfect reflection of society's expectations. What may not be so evident is that when we say society, we mean your customers, your employees, your stakeholders, and the employees of your customers and people thereby connected. Regulation is getting very prescriptive. It's hard to make the rules go away. And one thing that I've dealt with quite a bit in my prior life is the fact that the regulation landscape is very different from jurisdiction to jurisdiction, not just from state to state, but often at the state and at the local level as well. That's a new fact of life that makes life pretty difficult if you're a multi-jurisdictional employer. At some point, it's no longer practical to have one set of rules for Division A or Location A and a different set for the next one. And so often you have to kind of revert to the worst standard or the most rigorous one and apply that across the board, because that's just the only feasible way to get it done. But what I'd like to do next is show you some particular aspects of regulation and kind of weave together a quilt through example. So I'll give you a few vignettes here that I think will kind of warm you up at 8 o'clock in the morning on a cold day. California has some new so-called wage theft legislation. I put wage theft in quotes because I think there's two different dimensions to what's called wage theft. Part of it is if you really do steal wages from people, yeah, that's wage theft. But there's also a part that involves kind of ticky-tacky, follow the rules or else you get penalized kind of stuff. But in California, which as we know is kind of a bellwether for things that can and do happen across the nation sometimes, they have a new legislation, a new law that does take effect in January that makes intentional theft of wages or tips by employers punishable as grand theft. In other words, a crime. According to the bill's author, this law sends a clear message. If you intentionally steal workers' hard-earned wages, you can actually go to prison. This law makes the intentional theft of wages or gratuities in an amount greater than $950 for one employee or $2,350 for two or more employees, and in any 12 consecutive month period, punishable as grand theft at the prosecutor's discretion. Note in the construction world that employee includes independent contractors. An employer includes the hiring entity of an independent contractor. And the bill does not prohibit the employee from commencing a civil action to seek any remedies provided for under the labor code. I've done a lot of wage hour litigation activity in my career. I've been involved in literally tens of millions of dollars of wage hour litigation, involving allegations that you didn't pay people everything they're entitled to. Trust me when I say the laws get very particular, very specific. The way that overtime is calculated can get very difficult, particularly when you have embedded systems that are programmed a certain way. So this is a big deal. If you make a small, minuscule mistake on one person and you're running it through a payroll system, you can break through a $2,350 threshold in no time. Again, you may not have operations in California, but this is indicative of where things are going. Meanwhile, in New York, we have a new law coming up that automatically makes general contractors jointly and severally liable for wages, benefits, or wage supplements owed by subcontractors to construction workers. Joint employer status is automatically conferred upon the general contractor for the limited purpose of recovering any unpaid wages, and the statute permits construction workers to bring a civil or administrative action. That law takes effect in January. There are several states that have so-called pay transparency laws these days. Some states require affirmative disclosure of pay ranges, and the particulars vary by state, but Maryland, Rhode Island, California, Washington require employers to, at least under some circumstances, disclose the pay range to applicants upon request. Nevada requires it even if there's no request, as long as you've done an interview. Colorado is perhaps the most notable. They require what's called opportunity transparency. Employers with at least one Colorado employee must also provide written notice to its Colorado employees of any promotional opportunity, including any hire, change in job title, or material change in job duties, opportunities, or responsibilities before you decide who gets the new job. Even employees who are not qualified for the job must receive notice of this opportunity. I know, but Gary, these are all a bunch of blue states. We aren't in those operations. Well, here's a red state example. In Texas, as of September of this year, there are expanded protections against sexual harassment, and under those protections, individuals in management and companies that even have only one employee can be held liable. In the construction industry, this could sweep many subcontractors and tradesmen under the new law. The law will challenge the definition of who is a manager. Individual liability will hang on whether supervisors knew or should have known about sex harassment in the workplace. The new law also requires immediate and appropriate corrective action. Meanwhile, organized labor. No secret that President Biden has a very strong preference for improving the opportunities for organized labor to organize and to loosen up the conditions under which they operate. The National Labor Relations Board will be following suit. A notable recent decision involves so-called Scabby the rat. Maybe you've heard of Scabby. It's a big inflatable rat that they put up at work sites to complain about non-union labor. The NLRB recently gave erosion to the protection for neutral parties when the unions erect these large inflatable rats and other displays targeting businesses that have no direct involvement in the underlying labor dispute. As with personal liability and some of the other things that I'll mention in just a moment, these are meant to put more pressure upon organizations to make them comply. Meanwhile, I know we're all waiting for the so-called Build Back Better Act to be resolved. We don't really know what's going to be in it, and I'm looking forward to what our speakers this morning have to say about it. But there are some risk-related provisions in there, including some new employer penalties under the National Labor Relations Act, part of their budget reconciliation bill. Today, unfair labor practices by either unions or employers are remedied by requiring back pay and reinstatement to prior employment and employment terms. But the Build Back Better Act, at least in one form, would add new civil penalties in addition to the traditional remedies. These fines would only apply to employer violations, not unions. In addition, the bill would add civil fine personal liability for any company officer or director who directed or committed the violation, established the policy that led to the violation, or had actual or constructive knowledge of the events and the authority to prevent it, but didn't act to prevent it. Meanwhile, the Biden administration has announced that it will change the focus and no longer conduct workplace raids in order to take away all the non-documented workers. Instead, they're going to penalize the organizations who are regarded as exploitative employers who hire those unauthorized workers. So, it's a new, different environment that we're looking at. One other particular area that we need to talk about is the area of workplace safety when it comes to this. Now, during the Obama administration, there had been talk about socializing the use of electronic injury and illness records. In the waning months of the Obama administration, OSHA issued a rule that required employers to submit all their OSHA forms by an electronic reporting portal. But the Trump administration ultimately limited this submission to only the Form 300A, the summary form. But OSHA now wants to change their record-keeping regulation to restore the requirement to electronically submit the OSHA Form 300, which is the log, and the Form 301, that's the specific incident report, for establishments with 250 or more employees. These requirements will also involve likely OSHA using the information to send out warning letters, to conduct inspections, and to target employers who properly record injuries and illnesses if they happen to have rates above their industry average. The data will be available online, accessible to competitors, labor unions, and employees. And employee-centered interest groups are also likely to weaponize the publication of work injury and illness data. In other words, this is going to be another example of so-called guilt by statistics that we have seen in other contexts, particularly pay equity laws. Again, we don't know what all will be in that final Build Back Better law, but one of the things that was proposed is a massive increase in OSHA penalties. A congressional committee a couple months ago approved maximum penalties of up to $700,000 per item for violation of OSHA standards. The move would mean roughly a five-fold increase of maximum willful, repeated, and failure to abate violations from the current $136,000. The minimum penalty amounts for such infractions would increase from $9,700 to about $50,000. Serious violations would increase from the current $13,000 to $70,000. Again, we don't know if that'll last. We don't know if that will pass the reconciliation rules, but it's in there and it's indicative of where society is headed. Meanwhile, in September, California passed a new law which creates two new categories of OSHA violations: egregious and enterprise-wide. Employers can face up to $134,000 per egregious and enterprise-wide violation. Each exposed employee will be considered a separate violation. So you can take that $134,000 and multiply it by the number of people affected. The citation for an egregious violation can happen if the employer intentionally or through conscious voluntary action or inaction made no reasonable effort to eliminate a known violation, or if the employer has an extensive history of prior violations of this part, or the employer has intentionally disregarded their health and safety responsibilities, or if the employer's conduct taken as a whole amounts to clear bad faith, or if the employer has committed a large number of violations so as to significantly undermine the effectiveness of any safety and health program that may be in place. There will be a rebuttable presumption that an employer with multiple work sites has committed an enterprise-wide violation if you have a written policy or procedure that isn't in compliance with OSHA standards, or if there's evidence of a pattern or practice of the same violation. And the law gives OSHA the right to shut down workplaces. Meanwhile, OSHA is working on some new hazard communication standards that could expand your compliance obligations with respect to materials classified as hazardous. And if that weren't enough, OSHA, through its normal rulemaking process, is working on a heat standard. This would apply to both indoor and outdoor work. It would be countrywide. Because it's going through the normal OSHA rulemaking process, it will take probably a couple years for it to come about. Not much doubt it will come about. You'll have a chance to comment on it through, I believe, December 27 if you're interested. So if you have a stake in that, you might want to send in your comments. But no talk about regulation and safety would be complete without talking about national COVID rule, which is about to come about. So let's get this straightened out in terms of the landscape here. You already have an OSHA emergency temporary standard that applies only to the healthcare industry. You also have right now a contracting standard that applies to federal contractors who have to require vaccinations. What OSHA is now working on, and which President Biden has said will be coming about, and actually could hit any day now, would be a new emergency temporary standard that would apply to all employers with at least 100 workers. It literally could come out today. It has gone through the rulemaking authorities. It has gone through the through the administration's office that vets rules before publication. And as soon as it's published in the Federal Register, it will take effect. So we're just waiting for that shoe to drop right now. But it's through the regulatory review process of the Office of Management and Budget. When the administration will mandate compliance with the new rule is not yet known. Many industries have called for the mandates to be delayed until after the holiday season. Meanwhile, you have some new guidance regarding how to comply with the contractor requirement, which has a December 8th deadline. So there's a lot of moving parts in this area. And of course, I mentioned a few moments ago about these increased OSHA fines that can go all the way up to $700,000. To be certain, they would apply to any COVID-specific violations as well. So there's a lot to pay attention to in that regard. Now, an emergency temporary standard requires that OSHA satisfy a determination that the risk poses a grave danger. Emergency temporary standards don't come up very often. It's been quite a few years, other than the healthcare one that came up earlier this year. It is certain to be challenged when it gets announced. It will, by nature, be of limited duration unless replaced by a permanent rule. The emergency standard is supposed to be the basis for a new permanent rule. You can bet that there will be legal challenges galore. I don't know how it's going to turn out, but notwithstanding the legal challenges, unless a federal court stays the entire thing, you're going to have to be ready for it. To me, one of the real relevancies of these OSHA rules, including emergency temporary standards, is that they constitute evidence in the course of litigation, okay? In other words, if you violated an OSHA rule, that's going to put you at a disadvantage if and when you get sued for something else, or if and when a regulator comes in to sanction you for something else or to review something else. So they have relevance well beyond the nominal monetary penalties. Moreover, as I'm sure you know, many organizations study OSHA records, study experience mods and things like that when they decide whether you're a worthy contractor or not. So these things have a lot of business implications. Meanwhile, just to confirm a couple points, the HIPAA privacy rule does not prohibit organizations from asking individuals about their COVID-19 vaccination status, but any information thereby collected needs to be kept separate from an employee file because it's medical information. The Biden administration has also announced that under the new standard, which probably will involve a testing option in lieu of having a vaccination, employers will be allowed to charge the costs of testing to employees. They're certainly trying to pressure individual employees to get with the mandate. Let's move on to our next trend, trend 4. Oh, by the way, this chart is a chart of new case trends across the country. The fact that that number, if you will, is going down right now, I think will take a little bit of the wind out of the sails of OSHA, but it's still a pretty high number. Can they still meet the grave danger standard? I think they can, but that'll be argued out in court. The other thing that might influence this rule is the fact that we've got some supply chain issues, more on that in a moment, and that if a significant portion of the workforce gets taken out temporarily because of vaccination resistance, that might exacerbate some of the supply chain issues. So it wouldn't be shocking if a new rule comes out, but it doesn't take effect till January. But I don't know. We'll see. Remains to be seen. Let's move on to our next trend, and that is black swans. Have you ever heard of the notion of a black swan before? I think most of us have. But just in case we haven't, and I won't read the slides to you, as you see here, it's kind of a big deal event that's pretty hard to foresee. Because of its rarity and its gravity, it really isn't amenable to statistical forecasting in a sense, yet it can be profound in its impact. And black swans collectively have had a huge impact upon the course of human history. Whether it be pandemics or nuclear bombs or earthquakes or floods or what have you, it seems that we're seeing more so-called black swans than in the past. And the pandemic really brought risk management to the forefront. Some recent examples, as you see on the slide, COVID-19, the financial meltdown September 11, Fukushima tsunami, and plenty of others. So what about them? I think the key thing about black swans, and this is really going to get to the heart of what I want to say to you this morning, is that it has created a permanent ratcheting up in the importance of risk management. For many organizations, as you so well know, risk management was the central fact of life during the COVID pandemic. Risk management is a boardroom issue like never before. We all, I think, dearly hope that COVID will kind of go away or at least fade into the background somewhat, but the scars remain, and the focus on risk management as an enduring corporate priority, I think, will persist. But, and this is really one of my key points, the way your risk management and insurance practices were oriented, if you're a typical organization, is probably different than what it needs to be in the future. It's probably not that well aligned to the new realities of risk. More on that in a moment. Trend 5, talent. I'll bet we're all living this every day. It's no shock to you that talent is in charge. Good talent is in scarce supply. I think we've all experienced this. I think we all understand the consequences. With talent being in charge, we kind of work on their terms, accommodate my schedule. Particularly among younger employees, they want to believe in their employer's mission. They want their employer to be engaged in causes they believe in. I'm not so sure they'll still think that way if the employer takes a position opposite of their personal preference, but that's another story. Keep me trained, show me growth, make sure I'm not underpaid, because I identify more with my skills than my employer. That's just a new fact of life. The Society of Human Resource Management did some research on the lasting impacts of the so-called resignation tsunami on workers who choose to stay. Amid a wave of job resignations that's sweeping the country. According to SHRM research, nearly half of U.S. executives surveyed report that their organization is experiencing much higher turnover than usual in the past 6 months. More than 2 in 5 U.S. workers are actively searching or planning to search for a new job. The top 3 reasons they're searching are for better compensation, better work-life balance, and for better benefits. Following their former colleagues' exits, more than half of those who chose to stay say that they've had to take on more work and responsibilities. These workers are now left to reconsider their options, as 30% report struggling to get necessary work done, 27% feel less loyalty to their organization, 28% feel more lonely or isolated, and more than half are now wondering if their pay is high enough. This is the new reality of staffing. Some statistics accumulated by the Associated General Contractors of America indicate that construction employment remains below pre-pandemic levels in more than 2/3 of the states. It shows Michigan as being roughly static when compared to February 2020. But talent is not going away as a challenge for all of us. And talent is a big part of trend number 6, supply chain. Again, this is kind of all the rage these days. I'll bet you've heard a lot about supply chain, but I would ask you to look at it a little differently. Look at supply chain in terms of the upstream the downstream and the sideways aspects to it, okay? There's more to this than just your direct commodity suppliers. When looked at in that way, everybody has supply chain risk. It's just a matter of how it particularly impacts that organization. No organization is immune. Here's some of the examples of supply chain risk, which I think are, again, I think things you already understand. But let me read you a vignette that shows some of the potential complications, and I think shows the potential convergence between black swans, political risk, supply chain risk, technology, capital, and big data all in one. And this is from a organization called Osborne Capital, study released just a couple weeks ago. We maintain an ongoing list of existential issues that could have a significant impact on markets. Number one on the list today is China overtaking Taiwan, which we have listed as low probability, very high impact. Here's why that's such a big deal. Taiwan is the gateway for 63% of the global semiconductor production market and 84% of the high-end semiconductor market. I think those of us in Detroit have seen the impact on the auto industry of semiconductor issues. On October 8, China's leader Xi Jinping pledged to reunify with Taiwan. Taiwan's global semiconductor leadership looks attractive to China. Taiwan's semiconductor manufacturing capabilities are extremely precise and difficult to replicate. Many have tried, and all but 2 companies have failed. The other is Samsung in South Korea. If Taiwan were to shut down its exports for any reason, it would leave a massive hole in the global market for semiconductors for at least a few years, if not more. Taiwan Semiconductor is building a $12 billion facility in Arizona, and the United States has pledged $50 billion to support domestic semiconductor manufacturing, and construction started in June of 2021, but they won't produce their top-of-the-line chips until 2024. So as I said, the world's pretty complex, and a whole bunch of these trends kind of mix together at some point. Difficult to foresee. But that leads us to trend 7, technology. Technology as a threat and opportunity. As you see here, technology is deflationary, forces businesses to cut their costs, brings out efficiencies, facilitates new forms of competition, and is a reason for the increased mobility of capital. Technology arguably has at least 3 different impacts. As a trigger, cyber risk and privacy risk didn't exist when I entered the risk management business. They accelerate risk or concentrate risk. Okay? You're probably dependent upon processors and networks through which a lot of things pass. Cyber crooks have figured out that that's a good place to go looking these days. And meanwhile, thanks to technology, if you do something wrong, it gets out in public in ways that were never imaginable before. It's no longer dependent upon whether the Detroit Free Press publishes it in their printed newspaper. There's all kinds of ways for aggrieved parties to get the word out. Meanwhile, technology stores a permanent record of just about everything. Cyber risk is part of the technology risk palette. And as you see here, a recent global survey of risk managers ranked cyber attacks and data breaches as the #1 global risk concern. But to me, this is still on the black swan risk. We don't know yet how bad a cyber event really could be. If your organization buys cyber insurance, you're probably seeing the price go up. That's a reflection of the risk increase. The FBI has reported a 400% increase in cyber attacks in 2020. Ransomware makes up about 85% of those attacks. It's increasingly common to leverage the now booming ransomware as a service by purchasing access from other threat actors who sell it as a commodity. In other words, cyber risk has grown into its own business. Now threat actors are gathering sensitive information for espionage purposes, as well as traditional ransom payments. The fact that your systems are backed up while still essential might not be much help if your proprietary information is disclosed or sold on the dark web. In its 2020 Global Threat Report, CrowdStrike opined that an alarming trend in targeted ransomware operations is the compromise of managed services providers, which can enable the spread of ransomware to many companies from a single point of entry, affecting cloud service providers. Meanwhile, the insurance brokerage firm Arthur Gallagher notes that industries hardest hit by cybercrime have seen premium increases as high as 300% at the renewal times. Construction and manufacturing are among those taking the brunt of the price increases. And then capacity restrictions that took hold in 2020 are also intensifying. That's just reflective of the risk levels that are faced these days. So, we've covered 7 key trends. Before I go to what to think about this, I'd like to kind of go off track and make one other key observation. There is one other high-profile risk that needs to be mentioned, and it's your own organization's business strategy. If you study enterprise risk management, yeah, there's a lot of stuff to be worried about, but the biggest determinant of success or failure for an organization is its own business strategy. So while that's a little off topic today, I didn't want to continue without at least making mention of all that. So, I have pummeled you with all this frightening information about the new world of risk. And I think we understand that when something takes effect in certain jurisdictions, it tends to morph elsewhere. And who knows what's next on the list of bad things that someone like me might come up and talk about next year. But without solutions, a list of risks isn't very useful. I once got virtually thrown out of a CFO's office for coming and telling them all about all the things that could go wrong without any ideas of what to do about it. Nobody cares about a list of risks. But here's some key points, what to make of all this. Number 1, executive leadership and boards are more concerned about risk management than ever before. You're going to be more visible and accountable in the eyes of the public than ever before, but your risk management function wasn't organized for the sorts of risks we just reviewed. And ownership of some of these risks may not be settled in the typical organization. Finally, insurance isn't necessarily a very effective solution. What do you mean by that, Gary? Well, here's a table of my judgment of the degree to which certain types of risks are insurable. And forgive me for using some jargon in the middle of the page where it says contingent BI. That means contingent business interruption. It's a type of property insurance coverage that protects you for troubles experienced by your customers. A couple key points to be made about this page. Number 1, the stuff on the left-hand side is what your risk management function was probably assembled to deal with. Not so much the stuff on the right-hand side. As a consequence, your risk management function may not have as much familiarity or experience or competence regarding the things on the right-hand side when compared to the stuff on the left-hand side. Moreover, insurance tends to be a whole lot less effective or available for things on the right-hand side than for stuff on the left-hand side. Bearing risk and buying insurance as a gesture of operational efficiency is a whole lot more effective when you can be confident that if something happens, you at least have insurance for it. But when you're out walking on the rope without a net, you can't fall. That's our new reality. When you don't have insurance, you don't have a fallback. So you need to change your perspective. I've been in the risk business for 40 years. I was a full-time enterprise risk manager. I've done a lot of risk management consulting, and I can tell you it's just really, really hard to keep up with all this stuff. There are areas of risk that I know very little about. Some I know some about. But it's very hard to find anybody who can keep on top of all this. It's just too much. And even if you think you know what's going on now, thanks to the world of black swans, there's no guarantee that today's knowledge will be applicable to whatever happens to come up tomorrow. So, key point, you've got to change your perspective and how you prepare for all this stuff, in my opinion. So here's the most important slide that I will show you this morning. The new perspective is that organizations need proactivity, you need to prepare for consequences, not specific events, and you need to make technology part of your response. I'll talk about each of those in turn. But regarding proactivity, first of all, it just means not waiting for stuff to happen. We need to get our house in order as best we can beforehand. And I do say as best we can, because good efforts and good intentions, backed with evidence, will matter a lot in a lot of instances. So how do we get started? Again, your situation may be a little different, but this is a reasonable way to start. And take it as no more than that, okay? Do we understand all the key risks we face? Do we think that we accurately understand all the risks we face? Do we have an internal owner who's charged with being aware of that and doing something about it? If that happens, what could it mean for us? Do we have processes in place to ensure that we have an appropriate degree of visibility into this kind of stuff? To the extent we're lacking information and/or talent, what can we do about that? And are we outsmarting ourselves, or are we really getting holistic input? Not a bad place to start in terms of proactivity, okay? And again, I'm sure you could add a couple things to that. But the second thing I said, going back a slide, let's see if I can pull this off, is prepare for consequences, not specific events. What do you mean by that, Gary? Well, let's go back to my list of 650 things that could go wrong, or the 107 list that I showed you right at the start. Nobody has time for all that stuff. Nobody has time to figure out the relative severity or likelihood or velocity of any or all of those risks. The good news is that if they happen, they probably spill down to a relative handful of consequences. And because you don't know what's next, you're better off dealing with preparing for the consequences. Because there you get a manageably short list, and it may include the 8 items that you see. Maybe you can think of a 9th item, great, add it to the list. Maybe in your situation, one of these isn't very relevant, great. But when you boil it down to a list like this, now you can get particular. Okay, if we have people hurt, what does that mean for us? How can we be more resilient? Can we build redundancy? Are we overly dependent in certain areas? What could we do about it? That's the easier, sounder way to go about it, because you aren't betting on what's next. It's a hard bet. It still requires a lot of effort, and it still requires prioritization. And yeah, you risk being wrong, but you're going to do some good along the way. Perfection can't be the goal here. In particular, in terms of being proactive, here are some things you might want to do. Caution in some of these areas. If you go find trouble and don't do something about it, you might be in worse shape than if you keep your head in the sand. But these are effective things that you could do to go find trouble before it finds you. Wage hour is a big deal because if you have a violation, it probably involves multiple people over multiple pay periods, and the wage hour statutes are such that every distinct violation also involves a wage statement violation and a timely pay violation. And there are often statutory remedies, such as $1,000 per violation for such events. Plaintiff attorneys can blackboard numbers that are mind-blowing as a result. And that puts pressure on business owners and executives to say, I just can't take that risk. I've got to settle. And that's the game that's being played. Okay? A privileged legal audit will help you clean up your act before you get sued. Plaintiff attorneys are in business. They're good at what they do. They can clone successful theories. And if they succeed against one of your competitors or one of your customers, you may be next. Some of the other things, third-party cybersecurity assessment. There's lots of organizations out there that can assess your vulnerability. There are COVID-19 frameworks out there. The so-called New York HERO Act is one of them. That's actually a requirement in New York. Not a bad place to start in terms of, okay, do we have our house in order? There are insurance brokers who would just love to review your insurance program for free and give you their viewpoint on where you stand. You get the idea, okay? But again, be ready to take action. The third thing I argued for is technology needs to be part of the solution. Being reactive isn't good enough anymore. You probably don't have insurance. The social consequences are higher. The regulatory and reputational risks and financial risks are greater than ever before. So you got to get in front of that stuff. In many areas, it's very difficult to do that without technology. To prove what you did, to be consistent in your practice, to keep track of activity in real time and monitor it, to cut through the noise and really analyze what's really going on, to wall off information that needs to be walled off. In short, technology caused this predicament in part. Technology needs to be part of the way out of the predicament. There are tons of risk management tools out there. And we won't talk about each of them individually. I'll show you a couple examples in a moment. But kind of the typical technology stack in a risk management operation, and lots of operations don't have all of these, trust me. I could name you some big organizations that are still doing their core risk activities on Excel spreadsheets. But there are dedicated governance, risk, and compliance tools, which are kind of audit-oriented. Tools to do cyber risk assessments. Again, I won't read the list to you, but you get the idea. And they're all helpful. To the extent you don't have these and they're appropriate to your circumstances, maybe you want to think about one or more of them. There are some emerging technologies. Believe it or not, InsurTech is a big thing. And there's a lot of applicability of technology to the world of risk management. I'll show you a couple examples of some of these things. Workflow management is part of what my company actually does. And so you can equip people with mobile devices to go do safety inspections. Even an employee on day one who has no clue what they're doing, with the right tool can go out to a work site and accurately assess risk if given the right tool. Moreover, you have the backbone to do collaboration with our leadership chain to make real-time decisions about risk, and then to have a record of accountability for follow-up action to make sure that any deficiencies that have been identified are corrected in a timely fashion. So you get the idea there, I think. There's technology out there to monitor and manage construction risk. Here's an example of a tool that is used to translate construction-specific project risk management into a tool that identifies the critical paths and the things that could cost a lot of money in the way of construction delays. There are analytical tools out there that are far more dynamic than traditional Excel worksheets. that let you cut data in all kinds of ways, with the key idea being, get me down to the stuff that's most relevant, most important, the big difference makers. I don't have the time or resources to have a room full of people doing Excel worksheets that they are then tied into because they're too hard to change and update. I need tools that are dynamic, that let me deal in practically real time to find out what's going on in my organization. Give me that visibility. I'm a manager, I'm a leader, I manage processes. Give me high-level information that's a difference maker. That's what this kind of stuff is about. So, in the world of technology, my last comments here, how to proceed? Well, just as with the endless list of risks, there's an endless number of technology possibilities and opportunities out there. So here's how I would suggest going about it. Number one, work backwards. Start with your business needs, not with the path to addressing them. Forget about being the tech expert. You'll fill that in one way or another. It's not necessary. Don't boil the ocean. Pick a couple priorities, address them first, then worry about other stuff. But seek scale. Emphasize the repeatable, the lasting, and the higher volume. And then draw on your network. Engage multiple stakeholders. As I said, nobody understands all of this stuff. So, ladies and gentlemen, in conclusion, my argument is that an after-the-fact response is not sufficient in today's risk environment. The stakes are higher, the risks are different. You may not be organized in the way that's most appropriate for the new world of risk. My advice would be to prepare generically and emphasize prevention over reactive strategies, and to make technology part of your response. John and Jessica, again, thank you so much for the opportunity to speak this morning. If anybody has any questions right now, we're doing fine from a time standpoint, so be happy to take any questions either now or later this morning. But I can't thank you enough for your time and attention. I hope you found this worthwhile. Any questions?
Gary, you were talking about these COVID rules and applying to employers that are over 100 employees. Is that actually going to be able to be put into place for privately held companies? I know the majority of the companies that are here in our audience today are privately held, right, family businesses. And do you really see that as something that's going to be able to happen, or will it be, fights in court to get that? I can see public, I can see the hospitals, but the privately held, I think, is just a different animal.
Yeah. So as best as we understand it, John, and great question, the 100 employee rule will apply irrespective of whether it's a private or public employer. So whether you're privately held or publicly traded won't matter. And it's interesting that you could have 95 people all concentrated in one room, but not be susceptible, but another organization that has 101 people, each working out individually out in the field, would be susceptible. Another dimension to it is what counts as an employee. When you have part-timers, temporary employees, and that sort of thing. OSHA's traditional standard, which I think will be applied here, is that if you control the means and manner of conducting the work, you got to count them. So in other words, if you have 80 people, but then you use 30 temporaries, you're probably going to be over the threshold. If you have seasonal workers, but part of the year you go over the 100 threshold, you're going to need to have it in effect at least at that time. Does that 100 count make sense? Arguably not. But that's the way it's going to come down, at least as we understand it so far. But public or private status won't matter. Yes, sir.
Possibility of imposing civil fines. I worked at that Enron for years ago. They've already taken action which is irresponsible. Ever gets passed, Thanks, John. The General Counsel of NLRB has already announced a new concept of making allegedly wrongfully discharged employees whole. So for the last 60 years, if somebody was laid off or illegally fired, and this applies to non-union companies as well, the damage would only be pay them the back pay. Going forward, and again, it doesn't matter whether Congress passes this or not, any damages, consequential damages to that employee will have to be made by the employer. So if the employee lost 6 months' pay, as a result lost his house, the company could be forced to buy him a new house. If he went through a divorce because his wife was stressed and he was stressed and he had a huge legal bill for that, the NLRB could force that company to pay his legal bills.
Or if you missed a promotion opportunity
Absolutely.
or things like that as well. Yep.
And this goes beyond the next 2 years because the General Counsel in NLRB is there for at least 4 years. So even if the Republicans take over in 2022 or Biden isn't reelected, this policy is here for the next 4 or 5 years. So it's a big black swan.
Point well taken. And you know, one of the things I didn't put into the presentation, just in the interest of time, is the fact that in at least some of these contexts, like corporate misconduct, they're going to take the totality of your compliance record into account when deciding whether to sanction you for any compliance misbehaviors, particularly on the part of executive management. So these seemingly unrelated things can come back together. And again, that's another example of how pressure will be put on organizations to be compliant in all kinds of ways. And who knows where it's going to lead to next, but point very well taken. Thank you. Anything else? All right. Well, thank you so much. Really enjoyed it this morning.
Gary.
Thank you.
So as we all know, there's risk in every business, but in the construction industry, you know, it's at a maximum. So I would encourage everybody in the audience to reach out to Gary and talk to him because, you know, he's very well versed in this area and can really assist in your management of the risk in your business. So there's his contact information. We're going to have all this information for you at the end. So you don't have to jot anything down right now, but just wanted to make sure that you think of Gary and think to reach out to him. So we are going to take a 10 to 15-minute break. What I want to do now is introduce John to come up. He's an economist, professor at Walsh College, but he'll give you more detailed background on himself, and really looking forward to hearing what he has to say. So John, if you can come up.
All right, testing, it works. Okay. There we go. All right. What I'd like to do, I don't like podiums, but what we're going to talk about for the next few minutes is the infrastructure, the economy, some pricing, recessions, and basically this is an economics talk because I think it's relevant, especially with the turbulence that we are experiencing today economically, politically. We as an industry need to know what to expect over the next couple of years. And I'm going to tell you up front, it's full of uncertainty. So I got lots to talk about. I have some general projections to make when we finish up, but probably much like you, I have more questions than answers. We live in interesting times, as they always say. So my name is John Moore. I chair the Finance and Economics Department at Walsh College. If you've ever heard of the college, we're all business. And my perspective, let's see if I can, there we go. Okay. So a little bit of perspective on myself. I'll do a self-introduction here. I actually started in public accounting, of all things. I'm an accountant by trade. Coopers and Lybrand. It's now PricewaterhouseCoopers. I actually married a girl from Pricewaterhouse, so we were the original merger. We're about to celebrate 40 years of marriage. And I spent some time as chief financial officer. I've actually worked in the industry, so I'm an academic. I've been an academic for the last 15 years, but I've worked the industry. I worked for the Taubman Company for a number of years. I was chief financial officer for a company called R.A. DiMattia like 30 years ago. You may have heard of the company. I was chief financial officer, and I still consult with a company called Commercial Property Services, which is a private Chaldean company that owns a whole bunch of shopping centers throughout the United States. So here's what I can tell you. I bring some wonkish stuff today in terms of economics, but I have actually been awake at 2 o'clock in the morning staring up at the ceiling saying, how am I going to pay that bill tomorrow? Because my lender's not very happy with me, things like that. So I do have dirty fingernails as a result of being involved in the industry. But probably the one thing that hopefully I can bring today is I actually did work and live through that period of stagflation in the late 70s, early 80s. I did live through the S&L crisis. I did live through 2008. So these are all things, you know, we talked about black swans. Gary mentioned that. I can tell you right now that economic upticks and downticks are going to happen. We don't know exactly when. We don't know how bad they're going to be. I always like to talk about category hurricanes. 2008 was a level 5 economic recession. It was not good. I'm sure all of you probably still have nightmares and scars about your own experiences in 2008, 2009, 2010. It was not fun times. Okay, so what's the question that I want to tackle over the next few minutes? I want to talk about both the short-term and the long-term outlooks for construction and relatedly real estate in Michigan. So, you know, sub-question 1, what are the opportunities and what are the threats? Pretty simple agenda, but a pretty rich discussion, I think. All right, so here's the opening premise, and I think we have to just come to grips with this. In construction, we are a follower industry. We satisfy people's needs and wants. We don't all of a sudden build a bunch of buildings and line them up on Woodward Avenue and say, we got buildings for sale. So we are at the mercy of our customers. And so one of the things that I want to talk about is, you know, what's the perspective of your customers? What are these, you know, CEOs, presidents, CFOs, what are they all thinking in terms of, I need new facilities, I need to improve my infrastructure, and there will be opportunities. But, so, as a result, if all of a sudden the demand dries up, again, if you remember 2009, 2010, things got a little slow for a while. Maybe you guys slowed down in 08, 09, 10, maybe. Okay, so you know, what's it going to look like for the next couple of years? Long term, a lot of it's about demographics. Now, how many people here do most of their business in the state of Michigan? Raise your hands. Well, a fair amount. How many do a substantial out-of-state business? A few. So, okay, so I'm going to cater this discussion to a large degree on Michigan. I have information on Michigan, but I do have some national data as well. But here's what I tell a lot of my students at Walsh College. I teach a real estate class. In fact, I'm teaching it tonight. In the world of real estate, value follows feet. Wherever people are, that's where value becomes. That's why downtowns, you know, vibrant downtowns like Chicago have high rents. That's why houses in popular cities go up in price, and that's why other places prices go down. So it matters where people are. It matters what economic conditions are for your potential customers. There we go, right button. Okay, so let's talk about the detailed agenda here. I'm going to talk about short-term outlook. I want to look at the national economic outlook. I want to talk about the impact of COVID. I want to talk briefly about raw materials, energy, and supply chains. And then long-term impact, I want to talk about technology change and the long-term impact of demographic change. So 5 basically separate subsets that we're going to talk about, and then we're going to try to wrap it up and talk about what it means for Michigan and some overall conclusions. All right, so let's talk about the national economic outlook first. There are 5 things that I think are important for people to take a look at. One is GDP growth. A vibrant economy where we have economic growth is our type of environment. That's when we get kept busy. I want to talk about national debt because that's a side issue that I think will represents a potential threat. We'll talk about interest rates. Again, anytime your customers are looking for you to do work for them, they got to pay for it somehow, and the cost of money matters. We'll talk about inflation. There's been some rumors about that lately. And we'll talk about capital spending in the private sector. So, how many of you guys are familiar with the Federal Reserve Economic Database, FRED? I got 1 hand or 2 hands. That's okay. So, how many people here pay taxes? Okay. If you want some return for your investment with Uncle Sam, look it up. Federal Reserve Economic Database. If you just do that search term on Google, they have literally hundreds of thousands of graphs. So you're going to see a bunch of these in my presentation today. Hopefully well, you probably can't make out the vertical and the horizontal axis very well, but I'll try to walk you through it. But there is some great information there. If you really want to know about the world around you, the economic climate, once a month I have my list of about 40 things that I'm looking for, and I go just pop through it, and it's a very good source of knowledge. So let me give you a little bit of a lesson here on how to read a FRED chart. So in this case, we're looking at real GDP per capita. So again, not to go into academic mode, but real GDP per capita takes into account changes in population and changes in inflation. So it tries to create an apples to apples comparison along the way. This is the post-World War II era. So we're starting about the 1950s, and you'll see in this chart there's these little gray vertical lines. That represents a recession. Recessions are our enemy, especially for our business. You will notice, I'm going to exercise some risk management here. Gary, don't get worried. But you'll notice that was a really wide one right there. That's 2008. That's the one that hit us like a freight train. You'll also notice more recently we have this narrow one. That's the COVID. So here's the lesson that I want you to learn from this slide. We're looking at the end of World War II. That's a long time ago. Anybody here alive during World War II? I was not. Okay, so even before any of us were around, what you can see here, here's the long-term thing to think about. The long-term outlook is good. There is a constant pattern of growth. There is no reason to believe long-term that this pattern will ever change, absent war. If China and the United States get into a big disagreement and it comes to punches, all bets are off. But outside of that, I think that I can safely say that long-term things are good. But notice what happens here when all of a sudden you get these little gray things. These are called recessions. This is a boom, bust. This is when we individually as firms or companies get bruised pretty good. Sometimes we suffer broken bones. So let's take this chart and tie it down to just since 2000 and take a same chart, shorter look. Again, you start to see more dramatically the impact of 2008 and the impact of COVID here. So I guess I'm getting in classroom mode. Can I impose upon one of you to talk about how business was in 2008, 2009, 2010? Okay. Not good? In fact, since we're an implied company, it really sucked, didn't it? How many? Well, I shouldn't ask this because this would be a confession. How many companies here endured some financial distress during that period of time? Okay, let me do this. Anybody raise their hands? How many people did not experience any financial distress during that time? Okay, because you weren't working in the industry, right? Okay, exactly. That's the reason why. How many people, at least for a period of time in early 2000, were wondering if the sky was going to fall? Did anybody have to shut down their job sites? like by order of the governor, things like that. These are the things that cause us problems. So one of the things that I want to talk about in my presentation is, okay, what's the next gray going to happen? And where are we positioned and how we ought to be thinking about that? And I have some opinions about, well, yeah, okay, let's go to the next one. I have some thoughts about 2008 versus what we just are experiencing with COVID. So let's move on to another piece of information. Let's start putting the pieces of the puzzle together. Let's talk about national debt, nominal dollars. You'll notice, again, we're looking at a period here going back to World War II. We were just putzing along. This is right after World War II when we brought it down. Look at what has happened since 2000. Yeah, okay. So we've had a tremendous increase in the national debt. This is very problematic because this is what happens. When you have a significant national debt, you have to service that debt, you have to fund it, you can tax it, you can print money, or you can inflate. There's only a few ways to handle it, or you can grow the economy. So there's 4 ways to deal with a massive debt problem. If it's left unattended to, all of a sudden government and government programs start to crowd out the private sector. That's a problem for us. If we get too stuck into heavy government involvement in the economy, the private sector slows down, our customer base slows down. Here's a little bit of a follow-up on that. So we see debt came up from World War II relative to the economy. It came down ever since about the early 1980s. It has popped up, and in particular since 2000. One of the things that happened, and so that you never talk about politics and religion in polite company because you can only get into trouble. But you can cross party lines here. When George W. Bush inherited the presidency in 2000, the national debt doubled during his 8 years. When Barack Obama succeeded him, he doubled the national debt in his 8 years in office. Donald Trump was pretty well on his way. He only had one term, but there was a substantial increase in national debt under his administration. And frankly, if you read the headlines out of Washington, there's no reason to suspect that pattern is going to change at all. I would argue, and it's not something that we touch and feel on a personal basis very often, this is a huge threat to economic activity in our nation overall, and in particular to the construction industry. You know that's a problem because no politician will talk about it. That's a sure sign that's a problem. Okay, so another example, the same chart, again more recent, but you can see here that the debt to GDP number as of 2020 got to 128%. You may or may not recall that there was this thing in the early 2000s called the pigs crisis in Europe. Portugal, Italy, Greece, Spain, I think Italy was in there too. All these countries had all sorts of massive problems because their national debt had gotten way too high, and these economies really suffered during this period of time. So our cohorts in Europe who were in the construction business had a tough time. Those countries were getting levels of debt to GDP in the high 100s and low 200s. Are we there yet? No. But look at the trend. If the trend continues, we eventually will have a problem. Okay, interest rates. This has been one of our friends over the last number of years. Our customers have been able to borrow money or raise money at extremely favorable rates of return. This has been a great trend. This has been a boom for construction in the United States for well over 40 years. You know, we have little blips like the S&L crisis. We have blips like 2008. But if you actually look at it in the long haul, things have been good. Here's the challenge, though, to keep in mind. How much lower can interest rates go? And in fact, the Federal Reserve has signaled pretty clearly that they're looking to start to roll rates back up. They've been artificially low. When you raise rates, all of a sudden your customers have a higher cost of doing business. That will start to get reflected in their capital decisions. All right. Okay. So again, a more recent example of interest rates. You're starting to see already the pop-up. Rates went down generally after 2008. They really went down as a result of the response to COVID. Okay, inflation. So this is a little bit of a different graph to read. This horizontal bar here is zero inflation. So we had really high inflation in the, go back one. We had really high inflation back in the 70s and 80s. I remember that. It was, I remember when I first worked at Coopers and Lybrand for about $5 an hour, but the raises I think were 20% a year. It was just a different time. You'd buy a house real quick, stay there for 2 years, build up some equity, flip it into another house. These are all concepts that are foreign to anybody who's under 30 years old. But again, you see inflation has been fairly tame for the last 20 or 30 years. If inflation, the recent numbers coming out for inflation show some pretty interesting trends. Most recently here, the September number was 5.4%. That's the highest in 30 years. If you look at the rates of inflation the last 20 years, you're seeing 1s, 2s, 3s. That's a very stable environment. If all of a sudden inflation gets up into the 6, 7, 8, 9% range, it could be very difficult. I do recall I actually did get a bonus one year at Demadia because I got a loan for 10%. It was the lowest loan the company had gotten in like 10 years. It's possible. Okay, capital spending, good news. This private sector total is covering a whole basket of goods. But again, people are buying stuff. And on the capital side, not just the consumer side. We took a dive. We're back to normal. And I would assume right now that nobody in this room is having trouble with backlog. Again, you don't have to confess to me your personal issues with your company, but in general, demand's pretty decent right now. Companies are thriving. Well, thriving, doing decent. Okay, so let's take a look at capital spending non-financial, and the story's a little bit different. So this is now starting to narrow down into something that's a little more aligned with construction activity. So capital spending, non-financial. Now, all of a sudden, again, we see a pattern. We took the dip as a result of COVID. We came back, but now we're just kind of wandering at a level that's a little less than it was pre-COVID. It's open to tremendous interpretation, but my own view of that situation is that we have a lot of people, a lot of our customers, big ticket items, that are just kind of sitting on the fence right now. There's a certain level of uncertainty about where the economy is going. There's concerns about what national economic policy is going to be. This whole era of uncertainty is causing people to start thinking a little bit more cautiously in the area of big ticket items. And if we specifically get to construction, we again see a fairly strong uptick. So this is hardcore construction. My viewpoint, though, is that this is a clue. Go back. That this one is a clue as to where this one may be going over the next few years. Okay. So again, taking a look at construction, again, specific construction. I'll probably get this mastered by the time I'm done. If we take a look at non-retail construction, we're taking a look at a little bit of a dip there. Okay, so let's kind of sum up some thoughts about the economy in general. If we look at the economy growth long-term, good news. If we look about government debt and the fact that that could potentially slow down overall economic growth, there's some cause for concern. If there's a conclusion that interest rates are on the rise, which I think there's evidence to suggest so, it's cause for concern. If there's potential for inflation, that's cause for concern. CapEx spending, in terms of immediate demand on the construction side, mixed signals. So sobering, not as bad as the risk management talk, but cause for some concern. Okay, so let's talk about COVID for a second. Let's wander to the next topic. All right, so what are the human costs? What's the impact on the economy? What are the short-term and long-term consequences? So again, a little bit of background on myself. CPA, became a chief financial officer for over 20 years. I'm now a full-time academic. But my degrees, my undergraduate and graduate degrees are in accounting and finance. My doctoral degree, interestingly enough, is in business and economic historian, so I'm a professional historian. So I can speak with authority on COVID to some degree. So let's take a look at the impact of COVID. And this is an interesting statistic here. This basically says how many deaths in the United States per 1,000 per year. And the 2021 data is basically through about mid-year. But what you actually see, interestingly enough, COVID hasn't caused any significant spike in the overall U.S. death rate. Is it a tragedy? Absolutely yes. There's no denying that. I think, as John pointed out, it'd be hard to imagine anybody here who has not been touched by it in some way, shape, or form. So on a personal level, it's a very tragic event. But in terms of the overall economy, it has not disrupted the labor workforce in any significant way. Again, if we look at population growth, our population growth, by the way, is slowing down over time as we become more mature. But in terms of gross deaths, yeah, there's been a slight increase, but not substantial. If we look at age categories, and I throw this slide up, but just because I think it's interesting. Interestingly enough, the COVID, the COVID fatality rate. Let me get back to that slide. The COVID fatality rate, actually, once you get above 45 years, is almost consistent through age groups. Which I think may be, it certainly surprised the heck out of me. Here's the issue. When you're 45 to 54 years old, there aren't that many COVID cases. So what you end up with is you're less likely to get it, but as a percentage of overall deaths in your age category, it's about the same. The number of people who die between 45 and 54 from COVID are about the same percentage of those who are in the higher categories. But if you look at overall deaths, and again, this is data going through June, you'll see how what now has become 5 million deaths, 5 million deaths. The dominant majority is 75 and older. Okay, but let's put this in historical perspective. Again, you may not be aware of this, but humankind and viruses have been fighting each other for millennium, not just centuries. And there are times when the viruses get the upper hand. This happened during the plague of Justinian in 541, 542, 25 million deaths. We just had 5 million, with a much larger human population. Black Death, 75 to 200 million deaths. Spanish flu, just a century ago, 20 to 50 million deaths. We have suffered 5 million deaths. Tragic, every single one of them, but with a population that is more than twice what the population of the world was 100 years ago. From a scientific standpoint, from a demographic standpoint, it's actually a success. Our ability to respond to COVID and deal with it as best as we could under the circumstances has been nothing short of amazing. And in fact, again, talking about labor workforce, the vast majority of the deaths have been associated with folks that are already out of the workforce. So here's the interesting thing, and this ties into the earlier comments about the economy. In 2008, you had destroyed wealth. People had put all these money in the buildings, and the loans got called in, and all of a sudden, balance sheets disappeared. This downturn really represents the whole COVID, that vertical gray line that represents COVID. That was a massive timeout where, again, we had a pandemic, things shut down. We noticed that particularly in the construction industry. But it didn't harm infrastructure. It didn't really impair the workforce in any major event. So while it's technically a recession, it gets one of those gray lines, it's not an economic recession. It's a recession due to a pandemic. It's a black swan, as Gary pointed out. So it doesn't play by the same rules. So the real impact of COVID, obviously beyond the deaths, is it has changed our habits. The impact of COVID really is going to be more going post-COVID. How are working schedules going to work? Again, this is going to impact us. Anybody here involved in building office space? Nobody? Okay, I got some folks over there. You guys are going to get a lot of work over the next couple of years. It's going to happen. Not new buildings, but there's going to be a lot of reconfiguration in office buildings in a big way. Those space configurations, you're going to start seeing a highly increased hybrid environment, and you have all sorts of discussions going on right now. Is everybody going to go remote? Here's what a lot of leading business leaders are saying nowadays. There is productivity gains from having people work at home. There's the ability to save on rental space or ownership space by going hybrid. But there are certain things that are going to cause employers to be somewhat reluctant to go fully online. And they really boil down to two topics. One is mentoring. You can't bring new employees on board and effectively mentor them in a virtual world. Maybe someday we'll get there. Maybe holograms will all of a sudden show up in our house to give us instruction and look over our shoulder. But that doesn't exist yet. The other is cultural. Every company has its own culture and its own way of doing things. In a virtual setting, it's very difficult to accomplish that. So what you're going to see is, as a result, a reconfigured workspace world. You're going to start, just physical layout. The days of offices and cubes are going to be somewhat constrained. You're going to start seeing a lot more collaborative workspaces. You're going to start seeing workspaces that require a lot of amenities. It's going to be significantly reconfigured. There won't be a ton of new office being built. There will be a significant amount of rehabilitation to the existing office space. Life is changing. My wife and I actually were in Chicago earlier this summer babysitting for a week because our kids were so stressed out from COVID. They had to take a vacation, so Grandma and Grandpa came and took care of a 5-year-old and a 3-year-old. I tell you what, my back was aching by the end of the week from all the Amazon packages that showed up at the door every day that I had to pick up and pull on in. People's shopping patterns have clearly changed. We're scratching our heads. Obviously, we're getting old. But you are going to see significant shopping pattern consumption change. Think of Amazon as this. Amazon is the world's biggest shopping mall. It just isn't located anywhere. What are the implications for retail? Some implications there, although I would argue you still can't ship a watermelon very easily or make sure that the quality of your steak you're buying is good. So there's certain things that are going to be brick and mortar forever. But there are a lot of things that Amazon can do better than traditional retail. And we see this especially in regional shopping centers. Regional shopping centers, I used to work for Taubman. That used to be gold. It's not so much gold anymore. You're also going to find very interesting changes in lifestyle, again, because of this hybrid situation. And there was an author about 30 years ago by the name of Harry Dent. He's actually on the New York Times bestseller list for like a year with a book called The Roaring 2000s. And some books are good, some books are bad. Dent's book predicted a lot of things wrong. If you go back and buy it for $1 on Amazon, you might laugh if you read through it. But he actually had, in every so-so book, there's some good tidbits. He talked about as our society becomes more affluent, people like to work elsewhere in places where they like to be. And he basically says the future's exurbs. And this speaks to markets and where things are going to happen. He basically said exurbs are quality of life issues. We had cities, suburbs, exurbs is the next generation. Those are places that are close to water, close to mountains, or close to really smart communities. So in Michigan, a great example of an exurb would be Ann Arbor. You got the University of Michigan around there. I'm a Notre Dame grad. Go Irish, beat Navy. But you know, Ann Arbor is clearly has an eclectic community. Traverse City is another example where you can do sports, summertime, winter time all over the place. You're going to start to see in this hybrid world a lot of people spending more time in places like that. Those are going to be opportunities for business because people are going to change the patterns. In fact, Mrs. Moore and I are part of that train right now. We'll someday retire. I'm not sure when, but we've built our second house. It happens to be located in Virginia. I've been teaching from Virginia. We were there 100 days last year doing our job, working full time. That's an example of what's going to happen. All right, so let's talk real quickly about raw materials, energy, and supply chains. There's very little that I can teach you. You are probably far more on top of it than I am. But again, I have some information here to share. Let's talk about what the national outlook is for things like raw materials, for energy costs, some comments about supply chains. So this is the cost of drywall, gypsum actually. It's kind of all over the place. Anybody finding materials costing a little bit more now? Okay, we'll think about this because this ties into the concluding remarks. If it's becoming more expensive for our customers to get access to capital to build big ticket items, and the cost of the job itself is getting higher, those are things not working in our favor. Let's take a look at some other stuff. How about lumber? Of course, we had that big scare. Cost of lumber is going through the roof. It's becoming more valuable than gold. Well, obviously that was short-lived, but nonetheless, lumber prices still are right today, as we talk about it, are somewhat higher than they've been over the last number of years. Cost of plywood, very similar pattern. Iron and steel. Now again, I'm not sure what lumber went down. Iron and steel, the index right now has not gone down. I don't know the answer to that. Does anybody here have any insights into the increase in prices for steel and iron? Amazon? They just aren't shipping in time? Or they're consuming it all? Really? Bastards. Yeah. Well, China's definitely had an impact on things over the past couple of years. Their consumption when it comes to construction is amazing. Basically, cost if you're doing new industrial, this is what your customers are seeing: a very steady rise in prices. If you're doing new office, again, same story: steady rise in prices. And again, if we have inflation, the question then becomes: okay, we've had some real. This is where we had our COVID bit. Prices have gone up in the face of inflation. Are they is this temporary or long term? I would argue they actually are long term. Whatever inflation we have, it's not coming back down. That's a lesson from the 70s and the 80s. I can attest to that. Energy prices all over the map. But again, you're starting to see energy prices spike very significantly in recent times. Electricity, again, cost of energy going up. So again, adding costs. So anytime you now want to build a facility or do a major significant investment into an activity, as a customer, your cost of money is going up, the cost of materials is going up. It makes it more difficult to pull the trigger. And supply chains. This is a nice little graph. It gives some comparison. We're the United States. Here's the one thing where I'll say it's good news. We are feeling the squeeze of supply chain. And gosh, this is 24/7 on the news cycle. Everybody's always talking about supply chain for the last number of weeks. This is temporary. Whereas inflation is long-term, whereas the price of materials may be long-term, supply chain is a disruption in market process. For enough money, all those types of bottlenecks go away. People will solve it. People will come up with a solution. So while this is getting a lot of the headlines right now, notice that we're having far more problems than everybody else. I don't want to speak to policy or what others are what other parts of the world are how they're handling it. But this is temporary. It wasn't that long ago that we were fine, and we will be fine again. So my bottom line, it's temporary. So let's talk about costs. Raw material prices are increasing. There's a darn good chance they're going to stay up there. Energy prices, all over the map, uncertain. Supply chain clogs, short term. So not too much bad news there. All right, so let's talk about technology change. Gary talked a little bit about that. Let's talk about consumption and work and how this is going to impact the world that we live in. Okay, what is the percentage of, talk about the world of Amazon. What is the percentage of business that's going through e-commerce right now? I'm not sure I can explain this little downward trend. I don't think it's going to stick around. But we can see, since 2000, a significant increase in the amount of e-commerce, to the point now where we're looking into the high teens of every transaction. So we still live in a brick and mortar world, but this is a trend that's going to keep happening. So again, I don't know how many people here are industrial, but industrial's cooking right now. There's a lot of demand for that because of distribution through e-commerce. Computing power. And this, again, speaks to some of the things that Gary talked about. Here's another website. So Fred is one, if you take anything away from my talk, look up Fred, figure out what statistics will help you understand your job. There's another great data site. It's maybe not industry specific, but if you want to know more about the world that you live in and what's going on, it's called Our World in Data. It's a co-hosted site by a number of major universities throughout the world, and they just talk about all sorts of big picture things. I would highly recommend it that you put it on your computer as a link. But this is supercomputer power, and here's the way that you really need to look at this one. We're talking about 1 trillion flops in 1993, I think that is. We are now looking at 100,000 trillion. The world that we live in is now becoming incredibly data-driven. The amount of computing power, Gary again spoke to this a little bit when we talked about data analytics. This is the type of world we're in. Mind you, all of our customers that are building facilities, they're tapping into this stuff. Their business needs include this kind of stuff. And what I'll tell you is there any suggestion here that this trend is going to slow down or even go down? I think not. We're talking about a world that's going through incredible levels of change. Has anybody here ever read the book by Yuval Harari, 21 Ideas for the 21st Century? Anybody read it? Nobody. Okay. I would highly recommend it because Harari, now I will tell you, I assign it to my students. There's some things I agree with Harari on. I think there's a number of things that he's absolutely dead wrong. But it's one of those books that causes you to think because he talks about the impact of artificial intelligence on the rest of the 21st century. Our customers are going to be impacted by AI. Our industry is going to be impacted by AI. It's not manifested itself yet, but artificial intelligence has the ability to be a player in the construction industry. He was on 60 Minutes. Oh, was he? Yeah, he's a brilliant thinker. I think he teaches at the University of Tel Aviv, and he's an anthropologist by nature. But again, my preview is I didn't like a lot of things he said, but that made it a good book to read because it made me think.
The AI book is more or less saying AI is going to replace us.
Well, that's an area where I disagree with him. I'm getting off script here, but for a good reason. He views AI as the answer to everything, and we're all going to be unemployed. AI, at the end of the day, is a function of algorithms. And yeah, it can do probabilities. Creative genius is a human bit. AI can't love, it can't hate, it can't be jealous. All those, the 7 heavenly virtues and the 7 deadly vices, that's outside of the stream of AI. That's what makes us unique, and there's a certain element that AI can never replace. Harari thinks it can. I think he's full of stuff. Okay. Moore's Law, I would like to tell you it's named after me. It's not. I can't take credit for it. But Moore's Law basically says that, there's a doubling of capabilities within predictable periods of time. Again, this validates, this is going back to 1971. Transistors on a microprocessor. We're talking about how Taiwan's cranking all these out. Look at this trend. Again, there's no signs of it stopping. This is, I think very few of us know what the implications of this are. So I'm not here to tell you what's going to be happening 10 years from now. All I can tell you is there's big things that are going to be changing over the next 10 years that we need to be aware of. All right, so thoughts about technology. Consumers are migrating to efficient delivery systems. The economy is increasingly moving to the service sector. We aren't building nearly as many factories anymore. Manufacturing is here to stay, but it involves less workers because, again, if you talk about AI, when you talk about repeated production processes on assembly lines, AI can do that better than us. It's true. It certainly had an impact on machine tooling and everything else. There's going to be, and this goes into the general economic world that we live in, there's going to be a divide between the haves and have-nots. If you have high skills that are very human oriented, tied to creativity, if you have proprietary knowledge, like I would argue that Gary's assessment of risk is very difficult to replace right now through artificial intelligence. You talk about black swans, unanticipated events. That's things that AI is not capable of doing at this point in time. He is going to stay working until he's 99 years old as a result. But I see this at Walsh College. I'll see less than fully motivated students who are getting by on the C average. They can add numbers, but not a whole lot more. Now, that's not a typical Walsh student. I'm not going to tell you that. We produce great students, but every now and then you see one. And their future actually is quite bleak because you're going to see automation and AI do all those mechanical skills. We see this in the world of accounting already. Not to give away my age, John, but when I got into public accounting, there were like these green columnar sheets, and there was like a 10 key, and I had a pencil and an eraser. And I didn't have a computer screen during my entire time when I worked in public accounting because it didn't exist yet. All those things are obviously long gone now, and that trend will continue. Here's the thing that's going to happen. Less geographical constraints for high-level workers. They can work wherever they want. And you're going to see this hybrid bit where you can work wherever you want. You got to come into the office every now and then. We actually have this at Walsh College right now. We have a faculty member, a full-time faculty member, who lives in Florida. She's responsible for coming up once every month or two for administrative meetings. She's supposed to be at our place for graduation whenever we hold major ceremonies. But other than that, she can deliver all her stuff on a screen. And a lot of workplaces are starting to adapt that sort of attitude. Okay, so impact of demographic change. This is starting to get towards the end. So again, value follows feet. So construction activity is going to predominantly be where people are. It's a pretty logical thought, but sometimes you have to break it down to its simplest bit. Has anybody ever seen a demographic pyramid chart before? Okay, so this is by age going up. So these are babies. These are really old people. Blue is guys. Red, pink is girls. I always tell Mrs. Moore that you can see that there's more women alive in their 90s than men. I say that that's because we men put up with a lot more. I have yet to win that argument. But I tell her I make her so happy she's going to live longer. She rolls her eyes. So here's the national bit. And this ties into our discussion about Michigan. Here's the national bit. As you can tell, I will not get into detailed explanations, but we apparently are not procreating like we used to. You'd think that would be a pyramid. But you see the United States in 2010. This is the expectation in 2050. It's going to become a little more of a pyramid. You're going to see a whole lot more older people. Anybody do any sort of construction activity that's tied around senior citizen lifestyle or living? There's a market. There's going to be a lot more of them, and they got money. Now let's take a look at Michigan. This is 2010. The 2020 data isn't out yet. This is a funky demographic. Again, I'll go back one slide. This is the country in 2010. This is Michigan. We see this in higher ed, by the way, right now. I'm on the board of trustees for De La Salle Collegiate High School, so I talk about it at the high school level. We talk about it at Walsh College. Walsh College, our sweet spot for students is 20 to 35. Oops. Let me go back. What's happening there? There's like a skinny gap. We got lots of old people in Michigan, not so many middle-aged, and perhaps even more frightening is we don't have that many youngsters going around relative to the country. This is a very interesting trend that I think, this is a 10, 20-year issue in Michigan, but this actually does not suggest that we're going to be a heavy growth state anytime soon in terms of population, which, again, if value follows feet, that has implications upon our business. Okay, so this is a map where you just look at the colors. If you're Illinois, which is where my daughter and son-in-law live, you're losing population. Yellow is everybody's running for the hills. We're kind of in the middle in the light green. Here's where the growth is in the country. Atlantic coast south, Texas, west, except for California. Too many taxes, too difficult to do business. So anything that's really heavy green here, that's where people are leaving to. People are basically leaving the Northeast and the Midwest. They're moving south or west. And that's a fact. It's been going on for 20 years. It's going to continue to happen over the next 20 years. There's no reason to, or no evidence to suggest that that's going to change. Another way to look at it, if you are blue, you're growing. If you're red, you're shrinking in terms of population. People are abandoning small towns and agricultural areas and moving to more urbanized areas. And again, you see this as a very interesting trend in Michigan, where you see Detroit, Ann Arbor, Lansing, Grand Rapids, and all up that west coast where you got nice water and stuff like that. But there are other parts of the state that are not very healthy right now. And in fact, in general, in the Midwest, it's not healthy. You're seeing a lot of, where's everybody going? Texas, Florida. You got things here like Charlotte and Raleigh and Atlanta. And you see this, this is hot off the press. The United States House of Representatives changes the number, the apportionment of seats, not the number of seats, but the apportionment of seats every 10 years. Look where all the people lost. Interestingly enough, California lost a seat. First time ever in its history, lost a House seat. People are actually leaving there because it's too expensive. Where is it growing? Again, consistent with our conversation a couple slides ago, it's going southeast in certain places in the west. Okay, age dependency ratio projections. This is our world in data. It's for the entire world, but here's how you measure this. The ratio of people who are 65 and older or 14 and younger compared to the overall population. So I'm hitting this part. You know, I already mentioned to you, I babysit grandkids. I went to the chiropractor for an entire month after that experience. But I have two parents who are 90 years old now. So I got to worry about my grandkids. I got to worry about my kids. I got to worry about my parents. This number is rising. This again will impact. Will impact the world that we live in. Construction activity is going to modify itself to accommodate these types of situations. Births and deaths, very interesting enough. Again, a demographic issue. The world population has been growing. It's not growing as much anymore. Again, as societies become more affluent, the birth rate changes. So, what's the impact of demographics here? The United States is getting older. We're moving. Unfortunately, for a number of us, if we're local, it's moving away from Michigan. So let's talk about Michigan just for a second. Opportunities. So where are the greatest opportunities from all this? Office, I think, is going to be a significant opportunity for business over the upcoming years because of the change in how we're going to physically configure our workspace, given this post-COVID change in work habits. Distribution, warehouse, definitely going to be, it's going to continue to grow. Healthcare, because of our expanding population, is another area where there's going to be a significant amount of investment. In terms of local areas expanding, Grand Rapids, if you ever travel to Grand Rapids, there's cranes up in the air. There's more cranes there than there are in Detroit. Doing very well. Traverse City, I swear, I'm 64, so I have a lot of friends who, I'm still working, but I have a lot of friends who have taken retirement. and an awful lot of them are heading up to Torch Lake and Grand Rapids or Traverse City because they like it there. So those are opportunities. Threats, national economy is very uncertain right now. Interest rates are going up, as I mentioned. National debt's going up. Both those will slow the economy. So let me come up with some final thoughts here. The nature of our industry is cyclical. Think like your customer, just like in the movie Caddyshack, where Bill Murray tries to think like the gopher. Put yourself in your customer's seats. What's going to be their cost of capital? What's going to be their cost of construction? As those costs are going up, which the indications are that they are, it's going to become more challenging for them to pull the trigger. So understand that that's a potential threat out there. And obviously, the best builders will come up with the most bang for the invested dollar. Okay, but there are reasons for lots of optimism. Most of the issues have a good chance of stabilizing. Long-term GDP trends, as I said, it's been this way since the beginning of the industrial age. It trends up. What we have to do is look for the opportunities in this post-COVID world. COVID itself didn't necessarily impact our environment as much as consumer habits and corporate habits post-COVID. And what it basically is, it accelerated the use of technology. And that's going to have a major impact upon us. Overall, so here's the thing. COVID was not a real recession. We actually are due for one. It's been since 2008. We've been 13 years without a true economic recession. That's actually a very long time in the post-war world. It's coming, primarily because of government policy, not because of COVID. The good news is corporate America and private America, we don't have too much debt. In 2008, we took too much debt, and that's what caused the bubble to burst. That is not the case right now. All of my friends in the banking industry have acknowledged that their books are not too heavy. They don't have a lot of bad loans right now. So, my advice for what it's worth, I think it's going to be successful in our industry, it's going to be important to be entrepreneurial. You have to create a little more value add for your customers to get their business. If there's times for economic caution, you always want to keep your powder dry. You do not want to be worrying about making payroll and things like that. So my advice, because I see uncertain times right now, I think it's very important to not be too stretched out in terms of your finances. Don't take on too much leverage. I think something's coming in the next 24 to 36 months. 2008 was Category 5. This will be a Category 2. It's not going to be mind-blowing. It's not going to knock us all on our keisters. But something's going to happen, and I think it really revolves around economic confidence. The government's starting to crowd out the private sector a little bit because of faulty policy on all politicians. This will be a time to separate the firms that can do it very well from the ones who only do it okay. So that's my comments. I'd be happy to. I don't have any answers, but I hope I have prompted you to think about a lot of questions. So I'd be happy to answer any questions or comments that you may have.
So you talked about the debt to GDP ratio. With the two bills that are going through Congress right now, the infrastructure bills, which are trillions with a T.
Yep.
I mean, how much longer could that take to where we're in a situation where, because you said if it doubles, we would be in serious economic.
So let me take the historical perspective on this. Our debt is approaching $30 trillion right now, and so if we're looking at initiatives that are going to take on another $3 or $4 trillion of debt, you're basically expanding the debt by 10 to 15%. Nobody wants to talk about it that way. They just say a number. It doesn't sound nearly as challenging. But I think that here's the great danger, if you have some perspective on history. The problem with the 1970s, for those of us who actually experienced it, or some of us out here that may have read about it in the history books, is the 70s really was caused by the combination of the Vietnam War and the Great Society. And what happened basically was the United States economic policy took on a really big whale in terms of economic commitments. And the consequence of that was the 1970s. And You know, it was the age of polyester bell-bottom plaid pants and long hair, and all sorts of bad things happened in the 1970s. But my concern, and this is what could take it past a level 2, is that an inordinate amount of government debt, because there's only, again, you can tax to cover it. Well, you know, we talk about taxing rich people. Those are dollars that otherwise would be invested in stuff that we build. There's an opportunity cost there. You can inflate. You can just let the interest carry start to increase the deficit. Those are all unacceptable solutions in my mind. And so my greatest concern, the greatest level of uncertainty that people here should have going forward is, if those bills do pass, there is the opportunity for our economic distress afterwards to be much more severe. Yes?
This may have an obvious answer, but I've got to ask it. Over the last 10 years, payment terms to construction companies have really extended.
Yep.
The construction companies have accepted that for 2 reasons. One, they haven't had a whole lot of choice. And 2, with the cost of capital being low, they weren't worried about it. But when we see the kinds of things you're talking about, with the cost of capital going up, that's going to affect construction companies as well.
Yes.
What do you see on the impact on overall construction companies, both as an industry and as individual companies?
Boy, you say it, the question is actually not simple, because here's the problem, the scenario that can potentially play out. If you see the economy start to slow down, well, you know, the cure to all sorts of economic downturn is to keep your backlog busy. And so to beat your competitor to that next customer, you're willing to take those terms. And you know, this is the same thing that auto suppliers have dealt with in the auto industry. At some point in time, some of those companies that are getting so aggressive to hang on to the backlog are going to create a series of disasters if it's taken to its worst possible conclusion. Because A, you'll start not making money, because I know nobody here has a job that goes over projected timeline, or has to deal with change orders and things like that. But you know, is that cost of money from your bank, because you're essentially acting as an intermediary bank, you're taking on the cost of capital. If your rates are going up and you're not getting paid, you're going to start having you know, cash getting squeezed. You're going to have the cost of that money tie into your profits. And the company down the street that you beat the job for, they don't even have backlog, so they're starting to lay people off. And you're going to start seeing the entire industry have severe stress. And that's why I say keep your powder dry. The same thing, interestingly enough, and again, sometimes you want to analogize to different industries, the same thing happened in 2008 with the banking industry. So you have all these residential foreclosures that are going on. A bank doesn't want to operate a house or a building. That's not their business. They're in the banking business. So what they did is they foreclosed all this stuff and then threw it all on the market at the same time. Well, they oversupplied the market at a time when everybody was pinched economically anyways, and so they were selling stuff for dirt cheap. My son and daughter-in-law bought a house in 2009. It was like the perfect time. It was their first starter house. They got for dirt cheap. The same thing could happen in our industry as a result, and that's why it's very prudent. You can absorb that backlog with a higher cost if you have financial resources on your balance sheet to be able to absorb it. But if all of a sudden demand starts to slow down, that's trouble for the whole industry. Somebody's going to take the lead and keep the jobs and operate at a loss. Other people are all of a sudden going to lose backlog. I will tell you, again, relating a story. In 1991, I was CFO at a company. This is the S&L. All of a sudden, our backlog was sitting at like 100 million, and we did 20 million of revenue for a quarter, and the backlog was at 80 million. And then we did 20 million of sales revenues the next quarter, and the backlog was at 60 million. We laid off half of our company, and ultimately, what I found out, you know, you get smarter as you get older, we needed another layoff. That wasn't enough. So when bad times hit, be prepared. It's not fun. Hate to be a downer. I'm like Gary. Any other questions? All right. Well, thank you very much. Appreciate it.
Where do we stand? I feel like this guy, I don't know. They change on a daily basis. Just overnight, there was 2 new things that, one is definitely in the bill, one they're really trying to push to get into the bill, and we'll discuss those as we go along. There's really 2 bills. If you guys follow, I don't know if you guys follow, I've watched way too many CNN and Fox News over the last couple weeks, but there's the infrastructure bill, which we would all love to have passed, faster the better. And then there's this Build Back Better. I wouldn't even call it a bill. He calls it a framework. So, you know, it's a bunch of ideas that they really haven't put to paper. They're starting to do that. That was a lot of the reservation that people in Congress had, saying, well, you want me to vote on something that is a framework? So, you know, it's really crazy how they're doing things, throwing things in, taking them out, all at the last minute. Even putting through this Build Back Better framework that doesn't have, you know, any text behind it.
I'm just a bill, yes, I'm only a bill, and I got as far as Capitol Hill. Well, now I'm stuck in committee, and I'll sit here and wait while a few key congressmen discuss and debate.
So, I don't know, I'm showing my age, but this is from Schoolhouse Rock from the 70s, so I grew up in the 70s, all right? And I learned more from Schoolhouse Rock on Saturday morning cartoons than I did in all of 3rd grade. So between this and Conjunction Junction, what's that function? I'm telling you, I had English covered, I had politics covered, I had them all covered. Maybe people in Congress should go back and watch Schoolhouse Rock to see how the process is supposed to work. Clearly they're not following that today. So the Build Back Better framework and some of the big ideas that they have in there are extending child tax credits, universal pre-K. There's a lot in the climate and protecting the climate, healthcare coverage and upping those things, and they want to make sure when you get old you can have a hearing aid and glasses, housing, affordable housing, and tax changes that we'll be talking about. The other bill that we all hope gets passed, that they're kind of holding hostage because certain people in Congress are saying we're not voting for the one unless we can guarantee the other, because they want the social programs of the Build Back Better, is the infrastructure bill. So out of the infrastructure bill, here's a lot of some of the key areas that they're going to be covering and some of the dollar amounts that you can reference there. But I mean, these are all things in our wheelhouse, right? It's roads and bridges and airports, power infrastructure, rail, high-speed internet. It's all real, what I would call real infrastructure. You know, it's building roads. I know we have our road builders in the house today, and all those things that are real, tangible things. So hopefully it gets passed. It could happen at any day. We'll see where it goes. So this is just a picture of, you know, where we stand in the Senate, and which is what the problem is. You have to get somebody to flip here because we're at a 50-50 margin. The 2 yellow guys, one of those is Bernie Sanders, everybody knows him, who's independent but leans to the Democratic side. Here's the House of Representatives, and the Democrats have a majority in that House, but it's really the Senate where, you know, where it's the sticking point. So just over this last week, here's what happened. Biden went to Europe, and I don't know if I'm sure you must have seen him, where he gets up to the podium and he leans in, get the shot. Or he'll say, just go and vote. And I'm telling him, Joe, listen, you're supposed to be, you know, the wonderful Grandpa Joe, And he's really creepy Uncle Joe when he does that. He should stop doing that. Why is he doing that? I can't follow it. But on Monday, he got up and said, Joe Manchin, the Democrat that's kind of a conservative, he's on board. He's with us. He's going to get the vote. The next day, Joe Manchin says, whoa, 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 I'm sure we can get something done, but we're not getting this done. But hopefully we can get something done by Thanksgiving. Then, a couple nights ago, there was a Virginia governor's race, and the Democrat lost, and it was a big sign to the Democrats, and now they're all scrambling because they never expected that to happen, and they're foreseeing that to say in 2022, we might have big problems. So everybody's regrouping, everybody has a new strategy, and it's just causing a mess and holding everything up. So as fast as it's in, it's out. So this is a list of some of the major tax items that were originally proposed, and now they've thrown them out. So the yellow ones are the ones that I think are key, such as they were going to increase the corporate tax rate to 25, 28, maybe even higher than that. They've thrown that out. It's back to 21. Increase the top tax rate on ordinary income for non-corporate taxpayers. They would be individuals, right? They were talking going up to a 39.6 bracket. They took that out. They just reversed that out, and now we're back to this top tax rate of 37. The elimination of the basis step-up on property acquired from a decedent, that's a big deal. So if your mom passes away and you inherit her house, and she bought her house in 1940, and it was worth $50,000, but now it's worth $250,000 or $300,000, you get that step-up to that new higher value in case you were going to sell it or whatever. Well, they were trying to get rid of that, so you'd end up with this house with a value, a cost basis of that 1940 value of $50,000. So they wanted to throw that out because obviously that creates gain when you sell these properties, but that was thrown out. The limitation on the use of like-kind exchanges. Like-kind exchanges are really, really big deal. Hopefully everybody in the know is kind of familiar with what a like-kind exchange is. It's where you sell one business property, and instead of picking up that gain, if you take those proceeds and you buy something else, you can roll that gain over into the new property, deferring it and not paying it. They wanted to get rid of that, and the lobbyists in the real estate industry, because that's a huge deal for everybody, not just construction, lobbied really hard, and they got that thrown out. This one went over like a lead balloon, and honestly, as soon as it was in, it was out. So they threw out a requirement that banks had to disclose information regarding transfers to and from accounts. So any kind of deposit over $600 that went into your bank account was going to get reported to the IRS. Obviously, they're trying to raise revenue and tax you on every single dollar that flows into your bank account, and you have to prove that it wasn't income to you. It was just a ridiculous thought, an administrative nightmare, and like I said, as soon as it went in, the banks and their lobbyists got it thrown out. So the little thing at the bottom, though, says once something's introduced into a bill and it comes out, historically, people in Congress have been known to slide it back in at the 11th hour, take the bill to the floor. We have to vote on the bill. Everybody votes, and they don't realize that these things are put back in. So there is an opportunity that they might slide them back in at the 11th hour. Just overnight, one of my cohorts from UHY brought it to my attention that Pelosi is putting into one of the bills 4 weeks of paid family leave as a part of the bill. In addition, one of the things over the last couple of years that individuals have been crying about is in your itemized deductions of your tax return, you have a deduction for state and local taxes, SALT. before, if you are a business owner, you have a business, you're paying tax in multiple states all around the country, that state and local tax number can be very large. Well, they put a cap at $10,000 on that, and people are going crazy. So for the last couple years, I hear from all my clients, how come I can't deduct those taxes? How come I can't deduct the taxes? It's just the rule, it's just the law. So they are pushing very hard to get that reinstated, to take that cap away. So probably as a compromise, I'm not sure, but they're trying to get it reinstated so that SALT limitation doesn't exist anymore. So going through individuals and some of the things for individuals, I had this great chart of the current rates and what the new rate's going to be on the 39.6, and then they threw it out. So these are the current rates, and as of today, they should be flowing into 22 with the max rate at that 37%. So one of the things that Joe Biden has said all along is he wants to go after those millionaires, right? Those millionaires, those billionaires. So something that is new is a surtax on income. So if you have income, adjusted gross income in your tax return that's greater than $10 million, and you think, wow, that's a pretty big number. But if you have a sales transaction where maybe you sell your business or sell a piece of property or whatever, it doesn't take much to get an AGI over $10 million in a specific year. You're going to pay a surtax of 5%. If you have, if your AGI is over 25 million, you're going to pay another surtax of another 3%. So that's another 8% on top of the 37%. It's pretty steep. No change to the capital gains rate. We all heard and we were all scared. They were talking, 25, 28, 30, even higher, 28%. All these numbers were flying out there. They scrapped all that. Right now, as of today, there's no change to the capital gains rates. The estate tax. So UHY has done a lot of work with clients in the anticipation of they're going to drop that estate exemption amount from currently it's at 11 million, dropping it down to 5 million immediately. That's what they were talking about. They didn't do that. It's not at that amount. It actually is going to increase because of inflation. But it does sunset. So it is scheduled to sunset anyway. It will sunset in 2026, where it'll go back down to basically 5.5 million. So some of the things that individuals can do is to get rid of some income out of their estate is making sure that you're making gifts to your family and friends. The gift limit where you don't have to use that exclusion amount is $15,000. It's going to be going to $16,000 in 2022. And again, you don't use any of your state tax exemptions. One of the other things that they were trying to get rid of was what they call backdoor IRAs, what it allowed an individual to do. It was kind of a loophole that they're trying to close, where you could put in money for a regular IRA, then like the next day you take that IRA and you convert it to a Roth IRA. So the beauty of a Roth IRA is you don't have to withdraw your money when you hit 59 and a half. There's no required minimum distribution. So you can continue to let that grow. You can even pass it on to your beneficiaries. Or there's many ways to use that to give money away to charities. So they were really looking hard at this Roth. They saw it was a loophole and they were trying to get rid of it, but it's still in play today. So moving on to businesses, some of the things that were brought up on the business side of things. The net investment income tax, that's 3.8%. And currently, they tax that on interest and dividends. So it's tax that passive income over certain levels. 250, 350. What's the limit? Come on, UHY guys. Taxable income over 350, I believe. So if you have 350 in taxable income, you get hit with this 3.8, but only on your interest and dividends. So your income that comes through from a K-1 from your S corp or some kind of partnership return was not getting taxed. Well, now they have it proposed if one of these bills passes that base rate of 3.8% will also apply to active business income flowing through on these K-1s. So they're really looking to tax income in any way, shape, or form they can. So we talked about the Build Back Better framework, and one of those sections was taxes. So in that section of taxes, again, Biden's going after these big companies, and they want them to pay their fair share. So under the Build Back Better program, they were going to impose a 15% minimum tax on profits from corporations who, report over $1 billion. So those are big numbers. That's Amazon. That's Apple. There's also a 1% surcharge on corporate stock buybacks. A lot of these companies try to pull back their stock, get it out of the marketplace, and there's a surcharge to do so. In addition, there's some foreign taxes that I will leave to the international experts of the room that changed. And we'll go to the next slide. Okay, so this slide I always enjoy because when I talk to my contractors, right, they're like, listen, you're the tax guy, you handle all those things. But they're really proud of themselves because they know one code section, section 179, right? They love that code section. It's their favorite code section because they know they can buy those yellow toys that they love, and they can write them off and expense them immediately. So they're very proud to tell me, what's my 179 limit? I get that question every year. So this year, it's $1,050,000, but just as good, if not better, than Section 179 is they've instituted what they call bonus depreciation. Bonus depreciation you can write off, it's unlimited. You can write off 100% of what you purchased, new or used. However, there is a caveat there. Bonus depreciation is scheduled to sunset as well. So you see at the bottom, 2022, it's still 100%, but then it goes to 80% of what you purchase, 60, 40, 20, and then it goes away. So it is scheduled to sunset. So I wanted to point out one more difference between the Section 179 and the bonus, and this is really kind of like a planning tool for your accountant or your CPA, is that most states don't accept bonus depreciation. They never have from the beginning, but they've accepted 179. So if you do take bonus depreciation, you have to watch out for that because you actually have to add that back and then depreciate it over the regular rules, and then there'll be a delta. So you'll end up with zero tax on your federal return, but you might end up getting burned and owing tax on a state return. You're like, why is that? And it's because you've taken a lot of bonus depreciation. Something to watch out for. So net operating losses, nobody likes to have losses, right? Except when they can benefit us. So, the government put into place these rules for net operating losses to generate some cash flow for people. Typically, it was 2 years back and 20 years forward. So they have changed it slightly to say the new rule is you can only offset 80% of your income in a year with an NOL. So it still leaves you some income, right? You don't get to get rid of all of it. But back a couple years ago, because of the CARES Act, and they were trying to generate cash flow for people, if you generated an NOL in 18, 19, or this past 2020, you're allowed to take that loss back 100% and take it back to the past 5 years. So that was a huge opportunity, and hopefully if you fell into that bucket or that situation, you took advantage of that, because you always want to take tax dollars, right, when you have the opportunity, because you may never be able to go back and get those. That was a huge deal. But again, going forward, you're going to only be able to offset 80% of taxable income, but 18, 19, and 20, you should definitely, revisit that and make sure that you're taking that as an opportunity. So, in this unknown situation that we're at for the next 6 weeks, let's say, the golden rule of tax is always defer, defer, defer. Don't pay a tax dollar today that you can pay tomorrow, because who knows what's going to happen. However, with the climate, with everything they're talking about, that tax rates probably will go up if they can get their stuff together and make it happen. That's clearly going on right now, right? They're cutting deals left and right to get everybody consensus to pass these bills, and they have to raise revenue. John mentioned it. How do you get out of this crisis, this debt that we're in? How do you pay for all these programs that they want to do? You have to have revenue, so you got to raise taxes. So when they say, people under 400,000 or 450,000 won't have a single increase in tax, I don't think they're telling you the whole story. However, so because of that situation, you should get with your consultant, your tax advisor, your CPA, whatever you call them, and make sure that you're discussing that, because you may have the opportunity to pull income into this year and pay at lower rates. So you literally have to pay attention to the market. Hopefully your CPA is on top of it and communicating with you as things change, because they might be changing in the next week. They might change today. One of the other articles said that they might even have a vote today if they can get enough people in the proper categories and agree to it. They might even have a vote today. But as Joe Manchin mentioned, he's hoping by Thanksgiving, because then they go home for the holidays, and basically it's tough to get things done after Thanksgiving. So, two other things I wanted to mention before I wrap up here that I didn't put on the slide because it didn't have to do with the two new bills, but I'm sure everybody's aware of the PPP money and loans. There was a round 1, there was a round 2. By this time, if you were going to get any money, you should have already applied for 1 and 2. You probably should have already received forgiveness for round 1, but you may not have filed for forgiveness for round 2. So that clock is ticking depending on when you actually receive the funds for PPP2. You should watch that, but I would encourage you to put together your information, have somebody review it, and get it submitted ASAP so you're not missing that window. That window is closing very quickly. The other thing I wanted to mention was there's what they call the employee retention credit. That credit is very lucrative. So what it does is it looks at 2019 and compares 19 to 20 per quarter, and then 19 to 21 per quarter. And if you have decreases, you actually can get refunded money for your payroll taxes. In 20, it's up to $7,000. It's up to the first $10,000, and you get 70% of that back. So it's a $7,000 credit per employee. So you have to lay the numbers out, and you have to compare the quarters, and there could be some unique situations that even though you don't comply with the straight number calculation, you could still apply. There's a multitude of rules to follow. But it definitely, if you haven't taken the first blush and laid out the actual numbers, the data by quarter, you should do that and take a look and see where the opportunity is to go get these tax dollars. It's a great opportunity. So, with that, that is all I had for the tax section for today. So, does anybody have any questions? No? Great. Please, if you do not receive the UHY newsletter, let Jessica know, and we can get you on the list. Because we blast out things as things pop up and they happen. We're blasting out newsletters constantly. And if you don't see them, number one, check your spam. Sometimes they get caught up in spam. But number two, if you're not receiving them, let us know and we can get you on those lists. Because like I said, we spend a lot of time putting out a lot of e-blasts all the time. You know, the construction group, we personally put out a construction newsletter. Hopefully you're receiving that. That's like a quarterly newsletter. But we're doing e-blasts all the time, at least once a week. So we are towards the end. Just a reminder, if you need CPE, make sure you sign up. Oh, and keep an eye out for a post-event email. So that's going to have an event recap. Oh, you can download a copy of the presentation you just saw today. So I know that's important. A lot of people ask, how do I download, get a copy of it so I can, you know, go back and review it. So you'll be able to do that there. There'll be a link to the video if, you know, my jokes were so great you want to see them again. You can watch the video again. Fast forward just to the Gallo parts. And then there's a link to our tax planning guide, which is out there, which, you know, again, things are in such flux. It'll be a good planning guide. It might be a little generic because, you know, we just don't know these specific situations. But we will keep you informed, in tune, as long as you're signed up to receive our emails. So I hope everybody enjoyed coming back. I'm sure I enjoyed being live again. This was great. Appreciate everybody showing up. Please fill out the survey that you get with the email. You know, we do this for you, so we want to make this as best as we can. You know, so if the comment is get Gallo off the stage, I can appreciate that. Not a problem. But really, no, we do take those seriously. Jessica really summarizes them, and we try to change it and upgrade our talent, and that's why we have John and Gary today. Those guys did great. I want to thank you again. Thanks. So that's all I have. That's all I have for the day. Appreciate everybody coming. Have a good day.